Hello, I'm Leo Wang, and today we're analyzing the critical tensions pulling the global markets in opposite directions. A significant escalation in the trade war is on the horizon, with a new threat to impose a sweeping 30% tariff on all imports from both the European Union and Mexico, potentially starting as early as August 1st. My analysis shows this proposed 30% rate would be applied on top of existing sectoral tariffs, meaning levies on steel, aluminum, and auto imports would remain in place, compounding the economic pressure. This move intensifies global trade friction despite ongoing negotiations. Interestingly, the U.S. stock market has so far demonstrated remarkable resilience, largely shrugging off these latest tariff plans. Many investors appear to be looking past the immediate uncertainty, focusing instead on a potentially stronger economic outlook toward the end of the year. However, this market strength is about to face a major test. The corporate earnings season is kicking off, alongside the release of a key inflation report. These two events will provide the first concrete data on the real-world economic fallout from ongoing trade disputes. Expectations for corporate profits have already been tempered. Projections now indicate that S&P 500 companies are expected to see profits increase by just 5.8% from a year ago. This is a significant downward revision from the 10.2% growth that was anticipated just a few months ago. All eyes will be on major financial institutions like JP Morgan Chase, Bank of America, and Goldman Sachs, as well as tech and consumer giants, to see how their performance holds up. While the US has taken an aggressive stance, the European Union is currently holding off on immediate countermeasures, preferring to pursue further talks for now. This creates a window for negotiation, but the risk of a tit-for-tat tariff battle remains high. Adding to the complex picture, recent economic surveys actually point to a lower risk of recession and stronger job growth than previously feared. This creates a fundamental conflict. Geopolitical tensions are rising, yet some underlying economic indicators remain surprisingly robust. The market is caught in this tug-of-war, and many believe the risk of these aggressive tariff measures being implemented is currently underestimated. The coming days will be crucial, as hard data from earnings and inflation will determine whether the market's optimism can withstand this new wave of trade pressure.